Okay, the second week. What we're going to do now, from now to the end, mainly going to look at a business, the taxes with respect to business entities, not necessarily individual. Okay, that's what I meant. Business entities for tax two, that's what we're going to mainly focus on. So chapter 9 talks about business income, deductions, and accounting method use. Again, all these, whatever we have in this chapter, is mainly readings, but I can explain some areas that you might have a little, some complex or the topics. I can explain a little bit more in detail to understand it's better in that way. Some with some numbers and all that. There are some examples also, I think, in this chapter. They're supposed to have some examples. You can go over them. Then you will have a very good understanding what these things is all about. Okay, let's get to the material now. Learning objectives, identify common business deductions, determine the limits on deducting business expenses. There are certain limitations as to how much you can deduct, and what items you can deduct. Describe accounting periods available to businesses. And when I say accounting period, sometimes people use calendar year, sometimes people use fiscal year. Okay, so that's what we're going to go over. Apply cash and accrual methods to determine business income and expense deduction. So for the most part, if you have income on a certain, there's a threshold. This I think about 26 million and up, you're supposed to use accrual method. The gross income test is to check whether you are eligible as a business to use cash method. Okay, if your gross income is less than, I think this year 2020 is about 26 million or somewhere around. Okay, probably we will see that. Okay, the gross receipt test here, right there. Okay, gross receipt cannot exceed 26 million for the 3-year period preceding the current year. So the business without 3 years of data, use the period for which gross receipts are available. The gross receipt for short years must be annualized by multiplying by 12 and dividing the produced by the number of months in the short period. So we are looking at, if they don't have 3 years, usually you look at the 3 prior years and see whether they meet that threshold. The tax shelter never qualify on the gross receipt test. The tax shelters are usually what people do to avoid paying taxes, put somewhere else and such. Okay, that's the tax shelters. But that's when you test your gross receipt, that doesn't apply. Okay, business income and deductions. Deductions must be directly connected to business activity. The business income, we know what they are. Okay, whatever you're providing services, you're selling goods, whatnot, that's your income. Plus any other things, interest income, dividend income, whatever you have, whatever you get. As far as the deduction is concerned, you have says deduction must be directly connected to business activity. Business expenditure must be set forth ordinary and necessary to be deductible. Sometimes you might say it's $100,000 of deductions for whatever, maybe you taking a foreign trip, $100,000. Your total income is very small compared to what you're spending. So just probably that is your personal trip, vacation trip or something. We've seen that. People do that. They're trying to take the deduction for your own vacation. So is it necessary? Okay, so that's what it is. It's ordinary and necessary to be deductible. Ordinary and necessary means conducive to profit generator. Reasonable in amount means not extravagant, too much, not too much. Okay. Now here's a reasonable example. Let's take a look. Reasonableness. During the busy part of the year, Rick could not keep up all the work. Therefore, he hired 4 part-time employees and paid them the market rate of $10 an hour to more trim loans. That's his business. When things finally slowed down in late fall, Rick released them. Then Rick paid total of $22,000 in compensation to those four employees. Okay, that's reasonable. That's necessary to run his business, right? That's reasonable compensation for these employees. He can deduct that. Now, continuing the same facts, it says Rick still needed some extra help now and then, so he hired his brother, Tom, on a part-time basis. Tom performs the same duties as the prior part-time employees. However, Rick paid Tom $25 an hour. Why so, right? $25 an hour? He paid $10 an hour to those other people. Tom, being his brother, paid much higher. He did the same work. Okay, let's take a look now. Because Tom is a college student and Rick wanted to provide some additional support for Tom's education. That's different story. He can do whatever you want. You can pay his tuitions, whatever. That's up to you. Okay, but that's not deductible as a compensation to this employee. At the end, Tom had worked a total of 100 hours and received $2,500. See, $25 an hour, 100 hours, you get $2,500. What amount can Rick deduct for the compensation he paid to his employees? We know that $22,000 is good. That's the part-time employees. That's the normal rate. $22,000, right? $22,000 for four employees. $10 an hour. Well, this guy worked 100 hours. So how much he is supposed to be getting? $10. That's the regular normal rate. That's the reasonable rate. So it's $1,000. He get paid $1,000. He's only allowed, that's the reasonable amount for his work. So only he's supposed to get $1,000. That's the reasonable amount. So that's the only amount is allowed to deduct. Okay, everybody understand that? Oh, here we go. Here's explanation. 23,000. Yeah, Rick can deduct entire 22,000 paid to part-time employees. However, he can only deduct $10 an hour for Tom's compensation because the extra 15 per hour Rick paid Tom's unreasonable in amount. So you're not allowed to deduct that. The remaining 15 he can consider as a gift from Rick to Tom, right? Okay, everybody understand that? All right, statutory limits on business expense deductions. There are certain limitations as to how much you can deduct for certain expenses. Let's see what they are. Expenditure against public policy. Now, certain expenses. You may have some expenses, but it probably is business related to some way or another, but it's not allowed to deduct. Like what? No deduction for fines. You can deduct if you pay a fine, parking tickets or whatnot. Those are not deductible. Okay, that says against the public policy. You did something wrong. That's why you get a hit with the fines. Now, people don't pay taxes, get hit with the fines. Sometimes huge numbers, large corporations, so they cannot deduct those fines. And the bribes. Sometimes people has to pay some official some money to get things done. That's the business related stuff, but it's still not deductible. Lobbying expenditure, political contributions, those are not deductible expenses. Remember that. Okay, expense related to tax exempt income. Interest on a loan where the proceeds invested in municipal bonds and key employee insurance premiums are not deductible either. Okay, what is this? Expense related to tax exempt income. Suppose you borrow $100,000 at 3% interest, that's $3,000, right? And you invest that money to gain, say, 4% interest or 5%. So that says if you're investing on a municipal bond, you get $4,000. That is, I think we learn, it's not a taxable item. You should note you're not paying tax on this $4,000. Interest on municipal bonds are tax exempt. Okay. At the same time, if you use this fund to generate this income, which are not taxable, you cannot deduct the expenses related to that money that you borrowed. You borrowed money and invested it. Some people do that. You can borrow at a low rate and invest somewhere else at a high rate. People do that. Using someone else's money to make money. That's a smart people do that. Okay, then what do we have? Key employee insurance premium. Insurance premiums are not deductible either. And it's same thing. Insurance proceeds. Supposing what happens, usually the corporations insure their own employees, especially executive type of employees. So there's say it's $1 million insurance policy on a CFO or CEO, whoever it is. So for whatever reason that person passed away, whatever it is, you get the proceeds. That's the company gets it. It's not taxable. The same token, the similar to what we discussed before, the premium that you're paying to that cover that insurance policy is not deductible. Okay, the capital expenditure. Usually, if it's a capital expenditure, you cannot deduct right away. But capital expenditure, we're going to go over. I'm pretty sure next chapter we talk about how recovery or the capital expenditure, how you're going to deduct. Okay, now, as far as the capital expenditure is not deductible. Personal expenditure, it's not deductible, it's not business related. As I said, the limitation of business interest deduction. Okay, now we have a situation where you might have a huge interest expenses, but usually it's compared to your income, adjusted income. You have your net income, then you had to add back interest expense, you had to add back taxes and get the adjusted income. So I think the current rule says 30% is allowed. 30% of that amount is allowed. If you have more than that, it's not deductible. You can carry over to the following year, but it's not deductible for this year. All right. How about losses on disposition of business property? If you are selling a business property at a loss, but you can deduct as long as you're not selling to related parties. Okay, so that's what we're going to look at. Most probably we can look at some examples later on. Okay, looking at a capital expenditure, does the expenditure provide future benefit beyond this year? Then it is not an expense, you have to capitalize it. And what you do, you capitalize now, $1 million machine you purchase, you capitalize, then you depreciate it over whatever the life, 5 years, 10 years. So that's the depreciation part is deductible. Whenever you have a depreciation, it is an expense you can deduct. But it's not the capital expenditure. Okay, keep that in mind. That's two different things. 12-month rule for prepaid expenses, deduct if the benefit less than 12 months and benefit do not extend beyond end of next year. So you can deduct if it is less than 12 months. Okay, but if you have a longer period, so you cannot deduct this year, you have to deduct the following 2 years later. Okay, does not apply to interest expense. That does not apply to interest expense. Remember that. Okay, look at an example here. 12-month rule. Ben, a cash-based taxpayer, makes the following payments on June 30th of this year. $10,000 for the next 10 months of utilities. This is June 30th. Okay, so 10 months utilities they pay June 30th. So this year 6 months and the following year another 4 months, right? 12,000 for insurance over next 24 months. Then you got a 9,000 for the next 8 months of interest on a business loan. Okay, what amounts are deductible? That's a good question. Let's see how you're going to compute what amount is allowed to deduct. Yeah, they can deduct all 10,000 utilities because the benefit does not exceed 12 months and the benefit ends prior to the end of next year. Everybody understand that, right? That's only 10 months since June. Ben can deduct 3,000 for insurance because the benefit exists 12 months. Hence, the Ben can only deduct 6 months in this year. The total he paid, I think 20, some big number, right? So this is for 24 months. So 24 months for 500 times 24 months, this is 12,000. 12,000 they paid, but you allowed only 500 a month for first 12 months. So you can deduct $3,000 this year, and the rest is going to be deducted following year. Ben can deduct $7,200 for interest because the 12 months rule does not apply to interest. Again, as I said, mainly these are readings. Okay, so let's take a look at this one. Business expense with personal benefits. No business deduction for purely personal expenditure. So if the expenditure is its mix, you're going to, suppose you're going to a meeting in a foreign country, France, UK, China, wherever it is. So decided, okay, since I'm going to a meeting, so I stay there. Only one day we have a meeting. So he decided to stay 2 weeks. And roaming around, looking places. You spend time with his family. So if he went by himself, say it's going to cost him $2,000 to travel, airline tickets and hotels, whatever it is, $2,000, but he went with his family, plus he stayed 2 weeks, it cost $20,000. So that's what I mean. Okay, so you cannot deduct the personal part of that trip. Okay, it's only allowed certain amount. Business travel, okay, away from home overnight, otherwise allocate deduction to business portion. Okay, this record keeping is important because you got to show if the IRS gets your tax returns get audited by the IRS, they're going to look. Okay, you deducting $24,000 for what? What expenses? Show me the airline tickets and everything. You got to produce all this detail information, substantiation we call. Okay. We have here is a travel example. This individual paid the following to attend a business meeting in Chicago. He paid airfares $1,200, hotel 3 nights $750, meals 3 days $270. So the what amounts are deductible if Ben spent 2 days in meetings, primarily business. So that trip is primarily for business, right? So if that's the case, airfares, you can deduct the whole thing, right? He went there for primarily business, so he can take the whole thing. However, hotel 3 nights, they had only 2, right? They attended 2 days meeting, so that 3 nights probably stayed a little over. So he just has to allocate $250 a night, so it's a $500, and the meals 3 days. So he can deduct meals usually is 50%. So $270 is for 3 days, so that's $90 a day, correct? So for 2 days, so half of that is 45 times 2 is $90 is deductible if it's primarily business. So what if the primary purpose is the personal? So entire ARPI is not deductible, right? So everything else has to allocate certain way. Let's see what we got here. Here you go. That's how is the allocation supposed to be done. You can see here you got $1,200. If it's a primary business purpose, is the primarily business, so $1,200 is deductible. But it's primarily personal, there's no airfares deductible. You can see the hotel is $250 per day. The 2 days you get $500. So primary personal, you only allowed 250 is the only one day he attended the meeting, right? So just 250. And here is again for meals, as I said, is 50% is deductible regardless. So since business only 2 days, 2 days is 270, that's $90 a day. 50 times 2 is 180, 50 times 50% gives me 90. So if it's primarily business, he can deduct $1,790. But it's primarily personal, he can deduct only $295. You can see how they allocate. So only one day here, right? So, and then $45 for the meal, so just one day. Okay. The business interest limitation, again, as I said, there's business, the interest also, there's a limit as to how much you can deduct. It does not apply to any taxpayer with average annual gross receipt 26 million or less for the prior 3 taxable years. We call a small corporation type of entities. Okay, the CAS type of the CAS business taxpayer. The business interest expense deduction is limited to the business interest income plus 30% of adjusted taxable income. Business interest income plus 30% taxable income. We put some numbers. You will understand better how you're going to compute how much the interest is allowed. Adjusted taxable income is the taxable income allocable to the business computed without regard to any item of income, gain, deductions, or loss not properly allocable to trade or business. You remove that if you have any of those. Then you have interest expense or income. You remove that as well. That's how it's a taxable income. Adjusted taxable income. Okay, adjusted taxable income, interest expense and income. You gotta remove that. Depreciation, amortization, and depletion has to be removed. If you have any NOL, net operating losses, you got to take that out as well. When you say take that out, simply you have to add it back because it's a deduction, right? We put some numbers and see how that works. Okay, here we have an example. It's good. Now let's say this year MH Inc. reported $300,000 of taxable income on 30 million of revenue. Got 30 million revenue, got $300,000 taxable income. So in 30 million, you got a $300,000 of taxable income also. The revenue included 250,000. Okay, this is actually taxable. 300,000 taxable income of 30 million of revenue. So that revenue, this 30 million revenue is included in $250,000 of interest income is in there. 250,000 interest income is included in 30 million. In calculating taxable income, MH deducted 430,000 for depreciation, so you got to add it back, and 210,000 for interest expense, you have to add it back, right? What is the maximum business interest deduction this year? Let's figure it out based on the facts that we have here. Okay, start with taxable income. They say 300,000. Everybody see that? Interest income. So that's 250,000 is included there, right? So you got to take it out. Okay, interest income, you minus that. And you had to add depreciation. That's the depreciation you deducted. You got to add it back. And again, the interest expense you deducted, you have to add it back. So this one is included. That's why you take it out. Okay, so now we have adjusted taxable income of 600,000. Everybody good so far? 600,000. 30% of that is 210,000. That's allowed interest expense if they don't have any interest income. Since they do have interest income, you add that as well. Interest income you add to get to maximum interest deduction is 430. Maximum. So how much they're going to deduct? Interest expense 210. Say the interest expense is 210. That's the entire amount is deductible. Okay, losses and disposition of business property. Recognized losses are deductible. If How are you going to compute the loss of disposition of business property? Supposing you have machinery. You got a book value of 30,000. How do you get the book value? Your original historical cost, how much you paid for it, the minus the depreciation, accumulated depreciation so far, gets you a book value. So if the book value is 30,000, you are selling it for 20,000, you get a $10,000 of loss, right? Recognized losses are deductible. Losses on sales of related parties are not deductible by the seller. So what happens if this machinery was sold to a related party? Who are related parties? Maybe your partners. Maybe it's a sole proprietor, it's the owner, or the shareholders, or any subsidiaries, it's whatnot. That's the related party. Why it's not deductible? Because they can manipulate the numbers. It's not the third party fair value of that asset. Okay, if an owner wants to get that asset for himself or herself, they might say, okay, the company is going to sell it to him at a very, very low price, and company can claim the loss. That's why we don't allow. If it's a real party type of transaction, the IRS doesn't allow the loss deduct. Okay, casualty losses are limited to lesser of the decline in value or basis. Casualty losses, small losses here and there. Basis is the amount of loss if business asset is completely destroyed. You know what a basis? Basis is what we are talking about. A basis is simply the book value for the most part. Okay. So if you lost the whole assets completely destroyed for whatever reason, the entire basis is a loss. Okay, accounting for taxable income. So we know what a business gross income is, whatever revenue that you make. Okay, we learned this deductible expenses, what are allowed deductible, all expenses that are related to business, directly related to business, or you can allocable to a certain amount. Okay, now we need to match the income and deductions to a specific period. Counting period. Accounting method, match income and expense to a specific period. Let's see the numbers. Probably you can see some example later on. Annual period, full tax year is 12 months long. Short tax years sometimes, some people use short tax years, less than 12 months. The reason is, suppose you set up, this is a brand new corporation, you started the business somewhere in July or June, in the middle of the year. So if you're closing the books at 12/31, you don't have 12 months. So that's a short year. Okay, the same thing if you are closing it down. All right, year end, calendar year, so 12/31, or some people use, as I said before, the fiscal year. Fiscal year end any day before 12/31, depending on the choice. Last day of the month, not December. Any last day of the month, I would say. Okay. Accounting period of proprietorship. So now again, selecting an accounting period, you got to pay attention to certain things. There are rules. Proprietorships, same as a proprietorship year end. Proprietorships usually file a Schedule C. You have a business, small business, but your tax year is going to be the same as you are as an individual filing your 1040. It's 12/31. That's the proprietorship tax year. Okay. C corporation, an individual's choice made the first tax return, and it consistent with the book accounting period. Okay, then we got flow-through entities. Flow-through entities usually is a partnerships or it's corporation. Those flow-through entities. Those entities doesn't pay tax, but individual owners pay tax. If you're a partnership, partners pay tax. If a partnership make profits, it's flow through to the partners. That's what they call flow through entities. The same applies to S corporation. If you have an S corporation, we're going to go over the partnerships and S corporations later, but that's what flow-through entities are. Okay. Match to owners period, multiple owners for partnership, so this can be a little complicated. Suppose you will say you got partnership, say 5-6 different partners. So they file the returns, right? If you have a different partnerships, actually, multiple owners for partnerships, different partners use the different tax years. So that's going to get complicated. Okay, accounting methods. Accounting methods also is important uh, topic to learn when we talk about taxation. Now we know for financial accounting purposes we use GAAP, but for tax purposes it's something different, right? We use tax laws. We follow tax laws when you put together tax return. So what we have here, let's take a look. This in reporting financial and tax accounting method. In reporting financial statement income, the businesses have incentive to select accounting method permissible under GAAP that accelerate income and defer deduction. Why is that? Businesses like to brag about their performance, right? Businesses want to show we're doing well. We're making a lot of profits. So that's why they accelerate income. Everybody know what accelerate income means. Even they want to report more income this period than pushing back to the next period. Suppose some people try to, okay, if there's an order coming up, they know there's just millions of dollars of the product trying to sell. What they're going to do, they invoice that probably end of December and treat it as a sales for that period, thereby increasing income, okay, accelerating income. And on the other hand, they want to defer deductions. When you defer deduction, that means they push forward for the next year. The deduction is not going to be there this year, they're supposed to be there, or vice versa, right? So what's going to happen when you not deduct the expenses that are deductible? I mean, for financial accounting purposes, you have higher income. Less deductions, less expenses means high income. That's what they want. That's only for financial accounting purposes. But for tax purposes, they want the other way. They don't want to include income. They want to defer income, accelerate deductions. That's the difference between the tax accounting and book accounting or financial accounting. Permissible overall methods include cash method. People can put their tax returns using cash method. That's also depending on, there are certain rules to follow. Recognize income when received. The small businesses, mom pop type of entities use cash method. Accrual method recognize income when earned or received, whichever is first generally. Hybrid method, the mix of both. The method adopted with the first tax return, whatever the method that you're going to use, suppose you just started a business, you decided to go with the cash method, assuming that falls under the certain threshold, so $20 some million, you can use the cash method. If you're under your total revenue under 26 million or somewhere around, which you can use the cash method. Okay. The large corporation and partnerships with corporate partners must use your accrual method. Taxpayers that satisfy the gross receipt test can elect cash method. That's what I said. Gross receipt test is that you look last 3 years, you get an average going to be 26 million or somewhere around. So if you are below that, you can use the cash method. Cash method, income recognized when actually or constructively received, expense recognized when paid. What are the pros and cons? What are the benefits or advantages and disadvantages of using cash method? It's good, it's flexible, right? This process is flexible. The simple and relatively inexpensive, but there are a disadvantage. This is poor matching of income and expenses. You only report when you collect cash, not when you make a sale. Okay, but as far as, some person says you're talking about the sales. Usually we have a matching principle, says you have to match income against expenses, right? Expense against income. So if you are reporting sales, then accrual method usually use cost of sale, the other side, the matching. But if you're using cash method, you made a sale, but you didn't collect the money yet, right? But there's a cost. You paid for the goods that you sold. So in that case, you have expenses, but not the income that goes with that expenses. There are no matching, the poor matching. That's what it means. Can be used by taxpayers who satisfy the gross receipt test. Okay, that's the cash method. Accrual income method that we all know. Income is recognized when earned or received. All event test recognize income when all events have occurred. That fix the right to receive such income, and the amount can be determined and reasonable accuracy. Okay, that's why it's all events. You ship the goods and you know you're going to get the money. It's just accurately you can determine the amount to some level of accuracy. Okay, earliest of these dates: complete service or sale, payment is due, or payment is received. Again, I'm going to mention this one. I'm pretty sure you read this, you go over this. Now, I think I mentioned to a couple of students before, they had some questions about the Blackboard assignment. It appears to me that this is the last minute they assign me class. Okay, that's somehow they put those assignments on the Blackboard for someone else trying to probably had a schedule to teach. For whatever reason, that person didn't want to teach. The last minute they wanted me to teach class. So it's already there, those assignments and all the other things you see. But that assignments, it seems to me, I look at those though, it seems like they use 2020 book, but we are using 2021 textbook. So that's somewhat a different assignment. So what I decided to do, even though you can do those assignments, but I'm going to assign certain questions. Okay, I'm going to put questions at the end of these chapters, at least each week. Okay, each week count as a one unit. Maybe we cover 2 chapters, just 1 unit. Now we are covering this week chapter 9 and 10. When we're done with the chapter 9 and 10, I'm going to assign certain questions from the textbook, from the 2021 textbook. There's also textbooks assigned by the school. So that's what I'm using. And so keep that in mind. Okay, you just look at those questions and answer, and you can post them. I'm going to probably put them in the Blackboard. Blackboard is not automatically going to be graded, but I'm going to manually grade that for you. So that's the requirement. As far as the homework assignment concerned, I think that's much easier. It's not confusing for everybody. Okay, I do apologize for that kind of all kind of mishap. This is the first time the school doing this. We have to be patient they're doing a marvelous job, just assigning classes and everything. It's just not easy going almost all the classes online and all these things. It's assigning is not an easy task, okay, but they do that very well. All right, let's get back to this. Okay, let's go to the next slide. Okay, let's take a look at prepaid income. Advance payment for goods and services allowed to defer recognition for 1 year unless income is earned or recognized for financial records. That's the rule. It's allowed to defer recognition for 1 year. Sometimes we can get to some examples. They're not applicable to payment related to rent or interest income. So let's see whether we have some examples. This is an example here. Ben provided dancing lessons on September 30th of this year. He received $2,400 full payment for 2 years service contract. So what amount of income must Ben recognize if he is on a cash method or if he on the accrual method? Now you know it says on September 30th. So if he's a cash method, how much do we have to report? The total amount, right? Okay, let's take a look here. If Ben uses a cash method, he must recognize the income he has received, $2,400 this year. So if he uses accrual method, then he can elect to defer advances for service for a year. Now this year, the Ben would recognize $300. How you get the $300? The income earned from September 30th to December 30th. 3 months, right? September, October, November, December. So $2,400 for 2 years. So you can recognize only 3 months worth of income. Now that's 3 months is already earned. Therefore you recognize that, and the rest you can defer until next year. Okay, $2,100 you're going to record the next year. Okay, we get into look at inventory. How are you going to treat inventory? It's a very important topic to discuss. Inventory must generally be accounted for under the accrual method if sales of goods constitute an economic producing factor, which is almost all the time, for the most part, we say. The sales and purchase must be recorded using the accrual method. The hybrid method applies to cash method taxpayer with inventory who uses accrual for sales and purchases. So if the accrual method they have, they use the accrual method for inventory, the sales and purchases, but others they can use the cash method. The taxpayer that qualify under gross receipt test can opt to treat purchases of goods for sale as non-incidental material or use the financial reporting inventory method. Okay, whatever the financial reporting inventory method they use, they can use if they falls under the threshold at 26 million, the small business. Okay, so that's the exception. Okay, let's take a look. What is this UNICAP? UNICAP is simply what is say uniform capitalization rules. There is section 263A. I remember correctly, that's 263A. 263A requires, especially the manufacturing type of entity, has to capitalize certain indirect costs. Usually what we do, indirect costs, you expense it, right? Certain indirect costs, when you manufacture, when you say expense, you write off everything instead of adding to the cost of inventory. If you add whatever the cost to inventory, the product being produced, then there's no problem. Okay, that's amount is there. But usually, but we don't add some kind of indirect cost to the product. So what's happened? The cost, suppose you say you have $100 unit with the materials and the labor. So if you're not adding indirect cost to this unit, this is what you're going to see in inventory. This times the number of units that you have, the finished goods inventory, right? what if you allocate certain indirect costs, say another $20, what's going to happen? Your ending inventory values goes high up. That when we have a higher inventory, ending inventory, what that means? Your cost of sales is less, which generate a higher income, the taxable income, that is. Okay, this is for tax purposes only. They don't have to do that for book purposes. They can do however they want. But for tax purposes, you have to allocate certain indirect costs to the inventory. Okay, so what's going to happen? There has an adjustments. Now, if you don't do that, what the IRS does is, especially, you have to do it. That's an adjustment when you do it, UNICAP. As a taxpayer, you increase the inventory value, thereby increasing the ending inventory. When you have ending inventory higher, again, as I said, if you remember accounting 101, 102, whatever it is, and even intermediate level, at the ending inventory higher means you have a less cost of sale, thereby higher taxable income. So what happens the following year? It might get reversed because your ending inventory, that's what the high amount you reported for tax purposes, that's what you're going to use as a beginning inventory. Higher beginning inventory. Everything else being equal, what's going to happen next year? It's going to reduce. The adjustment is going to be other way, less taxable income. But still, IRS requires you to make adjustments for UNICAP. Keep that in mind. Okay, what it says. Inventory must be accounted for using tax version of full absorption rules. Now again, not just accounting, you're going to cost I think the cost accounting talks about this absorption rules, full absorption rules. Everything you're going to absorb the certain indirect cost to inventory, right? Indirect costs are allocated to inventory, not expense. Expense means you write off everything current year. Okay, there's nothing going to allocate to inventory, as I said before. But the cost of selling, advertising, and research need not be capitalized. Those things you can expense it. That's fine. But it's not the direct manufacturing type of cost. Cost of selling, advertising, and research is not manufacturing type of cost. Okay, that's the reason. Exception for the business that qualify under the gross receipt test. Again, now if you're making your gross income is less than 26 million for 2020, after then you don't have to really bother with the UNICAP computations. Okay, we're done with that. Inventory flow assumptions. You got a first in first out method. Everybody knows that. Okay, again, it's the costing. We learned that first in first out, or last in first out. Same method for financial and tax record. If you're using a first in first out for book purposes, you gotta use the same method for tax. Okay, you cannot use interchangeably. If you use the first in first out, the FIFO method, you cannot use the LIFO for tax. Okay, book tax conformity, that has to be the same. They generate lowest taxable income in time of inflation. Now it's depending on what method you use. It's going to give you the lowest taxable income. When you say inflation, what does that mean? When you have inflation, it's that prices goes up, right? Prices goes up. If you use the last in first out method, what's going to happen? Your cost is higher, so lower the taxable income. Put the numbers and see how exactly that works. When you say inflation, prices goes up. Prices goes up. Suppose I say in January you got a unit at $10 a piece. Okay, since prices goes up, in February you paid $15 for the same unit, so price is higher. So what happens if you use the last in first out method? You're going to use the $15 cost, which reduces your taxable income. Okay, that's what it says. Okay. All right, let's go to the next one. Accruing business expenses. All event test has been met. All events have occurred to establish the liability to pay. Let's see what all events are. The amount is determinable with reasonable accuracy. Reserve for further liability is not allowed. Sometimes they create a reserves. Reserves, especially this like insurance industry, they have exceptions to everything. But here you cannot really reserve for create a reserve for future liabilities and deduct. Okay, economic performance has occurred. If you are providing services, you provide the services. That's the event. You test the event. It's done. So then you can take the expense. Okay, that's what it means. Okay, we have here's an example of economic performance. Ben has signed a binding contract for Peter to provide Ben with repair services. Ben paid $1,500 to Peter and owes an additional $6,000 on the contract. The repairs will commence late next year. So, when can Ben claim the deduction if he uses accrual method? So if he uses accrual method, gotta wait until the services are provided. Now this is when he signed the contract. You see, later the repair will commence late next year. Okay. Solution here is although all the event test has satisfied, Ben can only deduct $7,500 next year because that is when economic performance occurs. Okay. Everybody understand that? All right, choosing or change in accounting method. Now we learned several accounting methods, even for the depreciation, the inventory, all that's the different method the taxpayer uses. Okay, the book purposes and tax purposes, they use different ones. Okay, especially the depreciation methods are different. So accounting methods are generally adopted by use. A permissible method is adopted by using and reporting a method for 1 year. If you start using it, that's what you're going to use. If you decided to change it, then you got to get the permission from the IRS. Okay, an impermissible method is adopted by using and reporting the method for 2 years. Generally, method change requires IRS permission. Okay, you cannot just really change one to another whenever you feel like it. The IRS is going to look at why you're changing it. You know, so that's why the IRS need you to get a permission from the IRS if it changes. Some changes are automatic. The permission is necessary to correct if we are using wrong method, impermissible method. So then still got to get the permission. All right, I think we're done with the chapter 9. Okay, we get into chapter 10 soon. Again, this is going to be I'm going to have a different video for that, okay, discussion, because this one take a little, it's almost an hour. It's take a while to upload these things. It take a while to create a video, but so I'm going to go to chapter 10 in the other video, and once I'm done with that, I'm going to give you homework assignments for both chapters. All right, make sure you go through those both videos and answer the question. I'm going to put problems here, and I'm going to also post them on Blackboard. Okay, all right.